Treasuries edging higher today following the Fed's 50 basis point cut and signals of more cuts to come. But our next guest says the bond market is pushing the narrative just a bit too much. For more on this, we welcome in Greg Peters, PGIM's Fixed Income Co-Chief Investment Officer. Greg, it's great to speak with you. Thank you so much. So I'm curious about this idea that the bond market is overreacting to the Fed. Why do you think that?
Well, there's been such a large move leading into this meeting, right? So the two-year note has rallied 150 basis points just in 2 months. And so it's just a little too much too soon. And I think you're seeing that in the reaction today where the bond market's taking a breather because what's built into the current pricing is just a continuation of a lot of cuts over 150 or so. And to me and to others, I think that actually has to be more of a tipping into a recession type of an environment, not a soft landing. So I think it's just a little too much too soon, honestly.
So then, Greg, what do you think, I guess, is more realistic? Are you in the camp more in line with what the Fed has actually forecasted, or what are you expecting? What's baked into your projections for future cuts?
Yeah, so I think there has been a revisitation by the Fed in terms of their future forecasts. I think that's much more in line with our thinking. What's interesting from a market standpoint is that it always pushes and pushes and pushes. And so there's a continued repricing. And when the Fed reprices, the market pushes even more. And so, I think the Fed projections are very much in line with our thinking. And I think they'll be rationalized over the next several months or quarters.
Can we talk about what Treasuries look like after that rationalization starts to kick in? 6 months from now, when we've all emotionally recovered from the past 24 hours, what are we going to see in yields?
Yeah, so I think yields are still poised to come down a touch, not a lot. We've seen a big move already. It's highly dependent upon the economy, of course. So a soft landing, I think we're priced appropriately. But I guess the excitement around fixed income is the hedge component of it, right? And so if we do actually tip into a recession or an economic slowdown, then Treasuries fixed income provides a tremendous offset to your portfolio. So I think that's the value of fixed income. Yields are higher. I think it's attractive, and you have that protective quality to it that you didn't see before when base rates were so low. So I expect continued enthusiasm around fixed income for the high yields and the fact that it does protect you.
Greg, when you talk about gaining some of that protection, I think a lot of investors are trying to figure out what exactly, investors are trying to figure out everything almost at this point. But when it comes to the bond market, just what exactly the path ahead looks like, especially for the yields. When you take a look at the 10-year yield, for example, we were talking to a strategist earlier in the program, and he was saying he expected to be in the range of 3.9 to 4%. And if we're within that, he thinks that a lot of what is already largely baked in and has already been priced in, it's not really going to move the equity market too much. I'm curious, do you think the risk that we could push above that 4% level in the 10-year?
I think the risk is only if inflation picks up. And so I think one of the black swan events for 2025 is with the economy looking to be okay, Fed being more accommodative. Does that create more inflation again? And the markets aren't really prepared for that. So it's not a base case, but that is the environment where I see yield moving higher. So absent that, I think we're in a pretty kind of range bound and if anything, a bias to lower yields, not higher yields here.
All right, Greg Peters, we appreciate you taking the time joining us here this morning. Thanks so much for your insight. PGIM's Fixed Income Co-Chief Investment Officer. Thanks so much.